We'll look at how asset classes have performed and what are some of the insights that you may glean into their prospects going forward. Our speaker that will cover this area and other areas with you is Mr. Rob Hogg. Rob is, as many of you would know, a senior consultant at Frontier. Ladies and gentlemen, please welcome to the podium Mr. Rob Hogg.
Thank you very much, David. During the course of the next 30 minutes or so, I want to look at the returns that we've seen in Australian equities. I also want to look at what's happened in terms of returns for bonds and cash, and just how important the influence of inflation has been in driving returns for bonds and cash. And then we'll look very briefly at property, infrastructure and private equity, because it's a lot more difficult, as you can imagine, to get sort of market-wide information there. And then finally, just look at some of the factors that are likely to impact on returns moving forward. So over the course of this time, a couple of things we'll look at are the fact that Australian equities performed incredibly strongly, not just in the last 10 years compared to the rest of the world, but for the last 110 years compared to the rest of the world. We'll look at the terms of trade and the impact that that has had. We'll look at inflation and at the impact that that's had as well. And we'll look then at where markets are currently priced and the yields currently available and what that means in turn for returns moving forward. This graph here goes back to the year 1990 and it's real returns from equities, bonds and cash. Over that period of time, equities have increased by a factor of 2,844. Over the same time, bonds have increased by a factor of only 4.7. and cash has returned by a factor of only 2.1. Now, I don't know about you, but when I first saw that graph and those numbers, I was quite amazed, and I guess that's what the power of compounding is all about. On an annual basis, Australian equities have returned on average around 7.5% after inflation over that period of time, so 7.5% real, whereas bonds have returned only 1.4% real and cash only 0.7. So as I say, over that period, equities up by a factor of 2,844, and that is by far the best performance of any major market in the world. The next closest market is actually South Africa, and the return there, or the compound factor there, is 2,100, so we're streets ahead of them. And then the next nearest neighbour is actually the United States at around 700. You might wonder what the worst is amongst the major economies, the major markets. It's actually Italy. And over that 110-year period, with income dividends reinvested, the equity market there has grown by a mammoth factor of 9. So Australia has been truly extraordinary, and a lot of that has occurred in the last 10 years. I just wanted to look at some of these returns, and again, the patterns here I really want to focus on are the fact that returns over the last 20 years for equities, Australian equities, towards the top of the graph, over a 20-year period, almost 10%, a little less over 10 years, and then a little less again over 5 years. And that's something we'll see across a lot of asset classes. The other thing I just wanted to point out was the very big difference, and I'm sure a lot of you will be very well aware of this, between developed markets and emerging markets. So if we look at developed markets on an unhedged basis, over 10 years, minus 4.6%, whereas emerging markets, positive 6.3%. But one of the things we'll talk about briefly is that, if anything, equity market returns actually forecast the future. They forecast growth going forward. Stronger expected growth is not enough to drive returns per se. This is the story of Australian equity returns relative to global equity returns. These are rolling 10-year returns. We've got 3 lines here. The blue line is the ASX200, the rolling 10-year, and then the green and the red lines are both the MSCI hedged and unhedged, all calculated on exactly the same basis. And the interesting thing here really relates to, and that's what we want to talk about, this most recent period where the Australian market has significantly outperformed, as we know, these other global markets. And we want to just drill down and see exactly why that has been the case. So this little graph of licorice all sorts really holds the key in terms of what has driven the Australian equity market. So we've got here a number of different Australian shares, a number of different Australian companies, all colour-coded. And the more important one, or the more intriguing one, over this period of time has been BHP. this sort of pink colour. So the black line shows us the total return in any one year. So if we look back to the year 2006, for instance, which is there, and look at the composition of the returns in that year, the market returned 18.6%, and of that, BHP alone contributed 5 percentage points, so around about a third of the total return of the market. And therein lies one of the main reasons why the Australian market has done so much better. And the swings that we've had in BHP's profits and contribution to the market in large part explain the year-to-year performance. So that's the actual stock contribution. So that's just calculated like you'd calculate the ASX index on any day. It's the size of the company multiplied by the price change. If we then look at actual earnings growth, the story is actually quite similar. So this is the same sort of methodology, but we're looking at the contribution on a company-by-company basis, the earnings of each of these largest companies and their contribution to the total market earnings. So again, if we look at the financial year ending June 06, total earnings in the market were around 20%, of which around a quarter alone was due to BHP. Now, I think we know a lot of the reasons for this, why has BHP's been so powerful, and indeed we could also look at Woodside and Rio, because together those three companies in a number of those years made up the vast majority of Aussie equity market returns, and that's been in marked contrast to the poor performance we've seen in global markets. This graph here looks at Australia's terms of trade. This is a ratio of our export prices to our import prices. So the two forces here over the most recent past have been the fact that our export prices, so that's things like coal and iron ore, have increased very, very significantly. Indeed, since 2003, the line or the gradient has increased very, very sharply. At the same time, a lot of our import prices have declined, things like widescreen TVs and motor vehicles and so on and so forth. The prices for a lot of those things have fallen. So in a sense, we've had this fantastic double whammy effect where our export prices have gone up and our import prices have gone down, particularly in this period since 2003. And a lot of that has been driven by this coal and iron ore story, and a lot of that in turn driven by the story with China. This graph here, pretty long term, going back to when Adam was a boy, shows us the varying proportions of China and other major geographic areas as a share of global GDP. So back around the 1850s, China was the largest single economy in the world at around 33%. That was the time when the Industrial Revolution kicked off in the West, and as a consequence of that and China's own policies at the time, we saw a marked decline in the share of China relative to the rest of the world in terms of its contribution to overall global growth. Of course, we all know things are changing, and if anything, if we look at what's happening with China and India now, it looks like they're headed back to a return to what has historically been the case. So in fact, we seem to be moving back to what has been the norm for several millennia and has just been abnormal just in the last couple of centuries. So the performance of a couple of stocks has been preeminent in explaining the market's return. The market in turn, the Australian market, has performed far in excess of the global market, and a lot of this is down to the story with the terms of trade in China. Another way of thinking about how markets produce returns is to look at earnings and how much we investors pay for earnings. So that's the price-earnings ratio. This chart here compares the story in the United States and Australia over the period 1999 to 2009. So the small grey bars show the total return of the price indices. So in Australia over that period, slightly positive, well, reasonably positive. In the US, negative. So over that period of time, the US market returned a negative return. The contribution to those returns is made up of the other two bars. Earnings, and the story with Australian earnings, very, very powerful. The story with US earnings, very, very weak indeed. And at the same time, both markets have suffered from what we call a PE compression, or a fall in the price-earnings ratio. So the amount that investors pay for earnings from the market. So Australia's benefited relative to the US and the globe indeed from much stronger earnings and a much smaller contraction in the price-earnings ratio that we pay for those earnings. Now, those price-earnings ratios are very important, as they are for any asset. Another way of thinking about them is the yield. If you look at the relationship between the PE that you pay for a market, and the PE here is on the vertical axis, and the annualised return over the next 10 years, there's clearly an inverse relationship, which is to say the higher the PE when you purchase, the lower is your return over the next 10 years. And that applies, of course, to any asset class. So Australia has had the advantage of starting the decade at a lower PE and having it decline by less and having strong earnings, whereas the US has been quite a different story. So in many ways, the last 10 years have been a most extraordinary period of time for the Australian market, all about the terms of trade, all about China, and really about 2 or 3 companies. So in looking forward, one of the most critical issues to assess in trying to guess which market's likely to do better really comes back to this whole China story. And alas, China being such an incredibly opaque beast, it's a very, very tricky thing. But to continue to get these types of returns, we need the terms of trade to continue to rise and for Chinese demand to continue to run ahead of supply. And of course, the day will come when that is no longer the case. I wanted to speak briefly as well just about emerging market returns. We saw on the table earlier that returns over the last 10 years from emerging markets have way outstripped returns from developed markets. But strangely, there's not a very close correlation between growth and those earnings, and as well, emerging markets over a longer time period haven't really outperformed by as much as would be expected given the huge differential in growth. And there are a number of reasons for that. One of them I mentioned earlier, and that is that in a sense, listed markets being forward-looking animals, they are looking forward, and in a sense they are discounting the expected growth. So when the growth arrives, a lot of that is already in the price. And that's one of the arguments put forward most often by sceptics about the emerging market story, and that is that if indeed there is a growing consensus that emerging economy growth will be so strong, surely a lot of that is in the price, and indeed a fair bit of that is in the price if we look at the pricing of emerging markets relative to developed markets. A lot of that re-rating and that closing in the gap has already occurred. But there are a number of other reasons as well why there's leakage, if you like, from emerging markets. There are things like family holdings in emerging markets that investors can't access. Of course, there are other big companies in the big developed markets that enjoy a lot of the emerging market growth, and BHP and Rio are classic examples there. And if you look at any of the major indices, whether it's the US or the UK, for instance, it is the case that a bigger and bigger proportion of those market earnings are coming from the developed world already. So just one more thing on this equity returns versus growth thing, and this little, I don't know quite how you describe it really, looks like a child splatter really, and I guess that underlines just how difficult it is to find a link between growth and equity earnings. These little dots here represent 4 decades of the relationship between growth and earnings, per capita GDP and earnings. And over that entire period, those 4 decades, across up to 83 markets, the correlation between the two is just 0.1, which is basically statistically insignificant. So it's not a contemporaneous relationship. In other words, emerging markets won't outperform today because emerging market growth today is stronger. It's all about how the growth is relative to expectations. And that's often what leads to the disappointment, not just with markets, but also with stocks. Moving now to Australian bonds and Australian cash. The story here over the last 10 or 20 years is really all about inflation, as I'm sure most of you realise. Lower inflation has driven lower and lower yields, and that then has driven capital growth in bond markets, and it's driven the annual coupon or the dividend lower and lower. So just to have a look at that, this graph just shows the trend in these various yields. With inflation, most importantly, this green line here, moving from a level of around 15 back in the 70s, steadily, well not steadily, but lower and lower and lower, and now it's very much within the Reserve Bank's 2% to 3% band. It's been there now for 10 years or more. That, of course, that has driven the yields on these other assets, bonds and bank bills, lower and lower over this time as well. And if I'd graph the returns from these markets, the returns would track very, very closely the movement down in inflation as well. So it's really the inflation story that has driven the yields down and driven the returns that we've had in these markets. This graph here decomposes the returns for Australian 10-year bonds. So a bond pays you a coupon every year, and there's also an element of capital gain or capital loss according to what happens to the price of the bond. So similar to shares, if the share price goes up and the dividend stays the same, and the dividend stays the same, you get a capital appreciation. It's exactly the same with bonds. And the story here is a little bit like the graph with inflation, in the sense that the size of the bars has progressively got smaller and smaller, and the contribution from the capital returns, which are the grey or the blue bars, have progressively got smaller and smaller and smaller. The coupons, the annual coupon that you get, like a dividend, has got smaller and smaller as well. And the reason for that is that coupons are set at roughly the prevailing market rate when the bond is sold for the first time. So as yields have come down, so the coupons have come down and down as well. And that, of course, has driven returns from 10% plus, lower and lower. We've had a couple of years where we've had negatives, 1994, 1999, and then, of course, in the most recent past, we've had this GFC effect. So it's really the inflation story here that has driven the returns, and we're now at a situation where those yields are now quite low, and a lot of the capital growth that we've got for bonds as they've moved from 11% all the way down to 4.5% or 5% has come and gone. Just moving on now to property and looking at the returns there by sector. It really depends on the sector that we're looking at of property. Some areas are more cyclical than others. We can see office here is a more cyclical return, so these are rolling annual returns. That, of course, is the serious recession. And then we've had the blow-off here, again in office. That was the pre-GFC euphoria, and then the weakness in the midst of the GFC. In the middle of all of that, retail has been a much, much steadier returning animal, office being really the more cyclical. And the returns here, very similar to bonds in the sense that we've had big changes in the capital return from property, the income return, a bit like the yields or the coupons, has generally moved lower through time. So a similar story, a lot of the fantastic outsized returns from property have likely come and gone as well for exactly the same reasons. Just briefly on infrastructure, much more difficult to get data, of course, on infrastructure, but it's market-wide data anyway. So in looking at infrastructure, speaking about the infrastructure team, these are really the elements that drive infrastructure returns. Now, a lot of them, of course, are very asset-specific, but changes in the discount rate, so that's related to inflation. Leverage, of course, we've all learned an awful lot, for better or for worse, mainly worse over the last little while about leverage. Macroeconomic factors, whether it's GDP or inflation, these are very important elements as well in driving infrastructure returns. And then depending on the type of infrastructure, whether it's a regulated asset, where changes in regulations are particularly important, or whether it's the life cycle of the asset, whether it's greenfield or brownfield. These are the types of things that drive returns. Putting together a number of infrastructure assets and looking at the sort of relationship that they have with other assets. This graph here just looks at the return of infrastructure, unlisted infrastructure, compared with a benchmark that is 50-50, equities and bonds. So through the fullness of time, a relationship there between all of those asset classes. Private equity returns, even more asset specific and even more manager specific, of course. The purchase price and the exit multiple, they're the key drivers. The economic conditions and the vintage year as well, also very important. Like infrastructure as well, progress along the J-curve in a sense is also important, the pattern of drawdowns and distributions as well. And very, very different, of course, returns according to the type of private equity, whether it's venture or other. Just finally, looking at the Australian dollar, what have been the drivers of the Australian dollar? Well, of course, a lot of them are related to the issues we've already been looking at. There's been a very close positive correlation between the currency and the terms of trade. So this graph here looks at the real trade-weighted index. So that's an index of our major trading partners taking account of inflation. There's a reasonably strong relationship between that and the terms of trade. But there's plenty of other things that drive a currency. Indeed, in my previous life, I used to often have currency strategists come into the office to give me their latest forecasts on the currency, and I would always think when they rang up to make the appointment, "You poor bastard. You poor bastard." There is no more difficult thing to try and forecast than a currency. But certainly in the fullness of time, in Australia, the terms of trades have been important, as have been interest rate differentials. As the interest rate differential, so the Australian RBA rate, as that has moved fractionally higher through time against our major trading partners, there's been a correlation there between the currency as well. So what then about the prospects? We've spoken a bit about inflation. We're now really at the end of that, well, getting close anyway to the end of that inflationary era. It's a disinflationary era where inflation's lower and lower but still positive. But we're now on the cusp of a potential deflation. And when you get there, you get a Japanese-esque, or you can get a Japanese-esque experience, sometimes called Gibson's paradox. And Gibson's paradox is where you get lower and lower and lower yields on bonds, but higher and higher yields on equities. So in other words, lower and lower equity prices and higher bond prices. And that's certainly been the experience in Japan, where even today, the Nikkei is, less than a quarter of what it was at the peak, and bond yields there are trading less than 1%. We've come to the end as well of this great moderation, where we had lower and lower volatility in the economic cycle, lower and lower volatility in interest rates, as we've seen. But then, of course, we all got carried away and leveraged up, and that gave us the GFC. So in a sense, we're moving into very, very new eras, with inflation now teetering on the precipice of deflation, but certainly with the huge tailwind of disinflation behind us, with the end of this great moderation. And we now look at a situation where yields on bonds are extraordinarily low across the globe, and yields on equities look a little more reasonable across the globe, but very much at risk from any potential change or any potential move into this so-called Gibson paradox. The other thing, and the final thing I just wanted to mention, is that we've also got to contend with this so-called new normal, as some have described it. So on top of all those other things, the new normal about the effect of less leverage and what that means for growth, greater regulation and what that means for earnings, and also the need to rebalance fiscal positions. That and the fact that there's much, much greater interest now by all investors, as there should be, in simplicity and transparency. So truly a new era, and Australia has truly lived through a golden age. Whether the China terms of trade story continues is obviously one of the very most important questions, and this inflation deflation as well, one of the very most important questions. Thank you very much.
Thank you very much, Rob. That was certainly given people something to think about, I think. We're in a position now where we're happy to take questions from the audience, and I think we already have one up the back on my right there. Please.
Patricia Newby, Invesco. I was interested, Rob, in the fact that you're talking about disinflation when we're hearing a lot of reports that America is probably going to have to inflate its way out of its problems. Do you see a sort of contagion eventually? I mean, when do you see inflation starting to be the bogey again?
Well, Patricia, the million dollar question. Indeed, if you think about the potential prospects for inflation, I can't remember a time when the potential range of outcomes is as broad as it is now. The last 10 or 20 years, as we've seen, we've generally seen in Australia lower and lower, but still positive inflation. That's called a disinflation. We've got to this period where it's around 2.5. If anything, Australian inflation is picking up a little bit, and a lot of that is to do with the fact that we've had very strong population growth, and there's a lot of pressure on a lot of services in particular. But so, if anything, Australia is a different case in the global arena. We've got pretty low in unemployment. We've got still reasonably growth. We've got very, very strong terms of trade and Australian income growth in total. So Australia is an island in the rest of the world. In the rest of the world, they are indeed teetering on the verge of deflation. In the US, in the last 3 or 4 months, The price level, so the inflation price index, has been steady to slightly lower. So that's the beginning of what you could call a deflation, a slight fall on the price level. But to move to the nub of your question, really one of the ways out is an inflation. And if we could wake up tomorrow and the Federal Reserve, the US Central Bank, said, okay, we're going to target an inflation rate of 5% for the next 3 or 4 years, and if the market could just adjust to that overnight, that would be one way out of the malaise in which we find ourselves. But of course, doing that is an incredibly tricky thing. Central banks have spent 30 years driving inflation expectations out of market participants' minds, and we've learnt that there are certainly benefits to having a low and steady inflation rate. You certainly don't want zero. It's handy to have, as the RBA does, this target of 2 to 3, because a little bit of inflation sort of oils the wheels. Too much inflation or volatile inflation brings about uncertainty, and that has an impact on all of our spending decisions. Clearly, deflation is very negative because nobody spends anything thinking it'll be cheaper as it will in a day or two. So I'm not sure how they might do it, but it'll be a situation where they'd need to move to a point where they could convince the market that this was a temporary thing to do, but it could all go horribly, horribly wrong. But it's certainly one potential way to inflate your way out of the significant indebtedness that they have. But presently, the outlook, inflation deflation, is as broad and as uncertain as it's ever been. We've been looking at Frontier at ways to hedge yourself from inflation, even though we don't see it anywhere near, and we've also been looking at ways to potentially hedge yourself against deflation because the outlook's so incredibly uncertain.
You showed the performance of the Australian market, but you also showed how narrow the Australian market is, and the returns depend on a handful of stocks. So that brings risk into the equation. Have you looked at the risk-adjusted returns, or how Australia's performed on a risk-adjusted basis compared to the rest of the world?
Well, I don't have the slide here, but relatively well compared to the rest of the world is the answer. But I'm afraid I don't have the graph here.
Well, perhaps, Rob, I could ask you a question, and I was asked by a member the other day, probably somewhat naively in one sense, why aren't you guys just investing in term deposits? They're great at the moment, was his view. Now, I know that we need to consider that in a wider context, but I guess really bonds, with what's occurred over the last 12 or 18 months, how do you see the role of bonds in our portfolios going forward in both a return sense and also in a risk sense?
One of the things that we've learned an awful lot about is that there are different types of bonds. There are government bonds and they behave in a particular way, and there are corporate bonds and they can behave in a quite different way according to the type of environment in which you find yourself. But if we just deal with government bonds, firstly, the yield on government bonds is incredibly low globally. The US 10-year yield is about 2.5%, the German yield's a bit under that, and the Japanese yield's a bit under 1%. So if you were to use no other guide at all, apart from the initial yield, and that is indeed the best guide to the long-term return, the long-term return from buying these pieces of paper is indeed very, very low. There are, however, other areas of the market where we think there's more opportunity. We had a session on Monday, in actual fact, looking at this issue of capital starvation, and there are areas in the domestic corporate bond market and the unlisted bond market where we think there's quite reasonable opportunity on a risk-adjusted return basis. Quite sizable yields in a number of areas there. These are areas that the banks have left alone. These are areas, maybe small and medium-term company loans and small and medium-sized company loans, where we think there's potential for quite reasonable risk-adjusted returns. But government bonds, on the face of it, the returns there, if you held them to maturity, are pretty low indeed. However, we've also spoken about this inflation-deflation thing and about the outlook being incredibly uncertain. In a deflation, there is really no other asset that will potentially go up, or will go up indeed, apart from a government bond. Now, a lot of people I know worry about the huge amount of supply that governments are issuing. In the US, they have a bond auction most any day that ends in Y. And that's the same story in the rest of the world. They've now issued more paper than they've really ever issued before. In a sense, it's a grand experiment, the amount of paper on issue. But so far, for all of those auctions they've had, more than 50% of the issue have been taken up by foreign central banks and also by various sovereign wealth funds. It's a roundabout way of saying there's still been significant appetite. It's usually in bonds, not the supply, that drives the price lower. It will eventually be the inflation. So if we eventually get to a situation where inflation expectations rise, that will be the death. That's probably too strong a word, but that will be a pretty treacherous environment for government bonds.
What are the places that you think we should be placing our money at the moment?
Well, you mentioned term deposits. Now, obviously you can't fill the entire portfolio with term deposits, but there's certainly some quite reasonable yields there, and certainly the cash yield here is a little bit higher than it was a year ago. The government bonds, as we were saying, don't seem to give us a fantastic risk-return trade-off. The equity yields look more reasonable than they have, but of course they're at risk from this sort of double dip story. Again, we really come back to these areas of capital starvation. Where are the areas of the market where most people fear to tread? Well, again, it comes back to this unlisted debt market. Because of the change in the structure of the lending market in Australia, there is indeed a significant need there for capital, debt capital. And that's been one of the areas where we've been looking over the course of the last really 9 to 12 months for opportunities. As well, we think there are some emerging opportunities in infrastructure and property potentially as well. But in the listed markets, not a huge amount of opportunity presently.